Thank you so much po, Ma'am Alma, sa pag-lead ng prayer.
Sige, chika na kayo ulit.
Ako, magchichika pa ba or go na tayo, Boss Arnold?
Tapusin ko lang yung food ko.
Same pala tayo, Miss Alma, kumakain. Ako din
Ilan na ba?
kumakain eh.
48?
Oo, lumapit ako sa laptop ko. Ay, 7 na ano na ako, join in ako.
Or
May
kumakain
mga
eh.
nag-join pa eh. That's
Sige po.
Pakabuti natin ng 50. 49, isa na lang pala hinahanap na.
poro na, poro.
Forum na tayo. So, ayun nga.
Sa amin naman kagabi, kasi sa Leyte kami. Tumawag ako
Opo.
nung tumawag ako, may mga aftershocks pa. Nakikita ko talaga yung mga
Ramdam
chandelier.
din sa
Nagsisipag.
Leyte?
Oo, malakas
Chris?
doon. Ang pamangkin ko,
Okay.
nagpanic nga siya eh. Kung saan nagpupunta, sabi ng ate ko. Eh kasi nakastira sila doon sa mama ko, ay sa papa ko. So sabi ng ate ko, mag-ano ka nga dyan, maging calm. Sabi, kasi nagpapanik siya. Ay, ano na yung pamangkin ko, 21-year-old at 21-year-old. Nagpapanik siya kasi sobrang lakas. Kasi natutulog sila. Tapos parang ginising sila nung earthquake na yun. Yun, parang nabigla baga. Yung nagpanik, diretso.
Kasi pag nagpapanik ka sometimes, yung kung you wanna save like ref, mabibit-bit mo kaya yun pababa, tapos di mo na maibalik
Adrenaline
pataas.
rush. Yung adrenaline
Oo.
rush.
Buti wala si Zera na bit-bit, no? Sarili lang niya. Eh, ang payat nun.
Buhay. Sabi niya, buhay o hanap buhay? Buhay daw.
Kaso buhay pa rin yung binili niya. Buhay pa rin. Bumaba siya ng ano. Dami naranasan ko yan sa Batangas. Mga ano yun eh. 4.7. Kasi may minamanage kami property doon. So nagtitrabaho kami. Alam mo sa sobrang panic ko, diretso ako takbo sa labas. Tapos iniwan ko talaga lahat. As in, wala akong binabitbit kahit cellphone man lang. Tapos ang laptop ko nasa lobby pa. Lahat nasa lobby, nasa ano. Wala na talaga akong pakialam. Wala ka dyan. Basta tatakbo ako.
Yeah.
Tapos sabi nila, bakit ka tumakbo? Bawal yun. Kasi nga, di ba, may mga debris, ganun, baka may magbagsakan. Tapos sa sobrang panic mo baga, hindi mo na alam gagawin mo. Kasi, maririnig mo yung glass nagkakaskasan. Alam mo yung tunog talaga. As in, nakakapanik talaga na para bang anytime magiba siya. Parang ganun.
Mababasag man.
Trauma kaya yung lindol.
Nakaka-trauma kasi hindi mo alam kung bigla-bigla lang siya.
Oo, bigla lang talaga siya. Wala man lang pakiparamdam na, oy, maglilindol ako ah. And like sa Baguio, di ba? Di kahit papano, may darating na ganito, low pressure area, ganyan, or malakas na hangin, or whatsoever. Pag lindol talaga, biglaan eh.
Oo, hindi natin alam. Ito, drop ba yan? I think 59 na tayo. Lagpas na tayo
Wait.
sa quota ni Marie Chris. Sige, boss, lead the na.
Sige, ayusin ko lang yung keyboard.
Okay po. A big round of applause for Boss Arnold.
Ngayon, share screen, tsaka sound. Dito yung sound.
Arnold, wala po bang
Arnold, anong
nag-volunteer
topic
sa ano
mo
mo?
na?
Sa group mo?
Nasa
Financials.
Susundan ko eh. Kasi nag-skip, di ba na parang nag-iba-iba na yung yung tawag doon. Pagkakasunod-sunod.
Hindi, ano pa rin, pang 5. Kasi 3-4 kami eh. Pang 5 yung kanya. Ay, 2-3. 1, 2,
examining
3. Pang 4
financial
pala.
statements.
Ay, oo.
So
Wala ka bang
screen.
kasama, Sir Arnold, na mag-present? Walang nag-volunteer sa team mo?
Wala eh.
Ang dami nyo Wala talaga.
Karamihan, nasa team replay.
Karamihan replay.
Mga working ba?
Pwede
Working
daw
din
si
naman ako.
Joel mag-read, sabi niya.
Nandyan siya?
Nag-message siya sa comment. Opo.
Okay. Kita niyo ba screen? Kita na ba?
Yes po.
Kita po.
Saan napunta? Ito. Same thing, Joel. I'll just go on the items that have questions. The rest you will read, okay?
Okay.
Okay, let's start. Let's start with the overview, Joel.
Okay. Good evening. As a bookkeeper, you encounter many financial documents in your career. There are four key ones that every bookkeeper and accountant uses
Joel, parang
regularly.
mahina. O ako lang.
Hello? Mahina po
O
ba?
sige, nilakasan ko na
Mahina
yung
po.
audio ko. O medyo mahina nga.
Mahina. Hello? Okay na po? Hello?
I think.
More
Yes po.
feelings daw, sabi ni Dex.
Try ko po, ulitin ko. As a bookkeeper, you encounter many financial documents in your career. There are four key ones that every bookkeeper and accountant uses regularly and should be familiar with. Scroll down. The balance sheet, the income statement, also referred to as the profit and loss statement or P&L. Number two, the statement of cash flows. And last, the statement of equity. These four statements are interconnected and provide valuable insights into the health, performance, and financial state of a business. Bookkeepers analyze them to understand financial trends, performance indicators, and cash flow within the business. It is important to be familiar with these statements, how transactions are recorded in them, the relationships between them, and how they are used to create budgets and compare them with actual financial results.
Okay, so this part is just a review of the bookkeeping glossary. If you want to take a look on those. Next slide is financial statements review. Understanding the financial statement is the key. Let's review some important terms related to financial statements that you should be familiar with at this point. Okay, so a set of reports that show how a business, parang laki, how business performing financially and all business activities related to running the business. Is it financial statements, adjusting entries, chart of accounts, or financial ratios? Of course, it says here reports, and the only thing that refers to reports are the financial statements.
Okay, correct. That's financial statements.
Okay. Question 2. Financial statement that reports a business assets, liabilities, and equity at a specific point in time is the balance sheet. You all agree?
Yes po.
The balance sheet is correct.
Question 3. Also called the profit and loss statement. It shows the business revenues and expenses during a particular period. Profit and loss is the income statement. Question 4. Reports that the sources and uses of cash by business. So keyword is cash, sources, cash in, cash out, statement of cash flow. Question 5. Reports the changes in a business equity from the opening balance to the end of the period balance. Equity, statement of equity. Okay,
Great
good.
work. You have completed the activity.
Okay, next slide.
Now let's
Take a
take a
deeper.
deeper dive into each of the key financial statements. Balance sheet displays business assets, liabilities, and equity.
Mm.
In the following video, you review key points about the balance sheet.
Sana meron. Meron?
Ako, wala na namang audio.
Ah, okay. You want me to read this or you read?
I'll try real quick. The balance sheet is a financial statement that shows the business assets, liabilities, and equity at a specific point in time, following the accounting equation. It provides a snapshot of your business on a given day. It helps track what the business owns or assets, what it owes or liabilities, and the remaining value of the owner's or the equity. Remember, assets also include the business capital, which represents the monies the business uses for operations and growth. This can include cash, debt, or equity. When not using software, the balance sheet is most often set up with the assets on the left, liabilities and equity on the right. But when using accounting software, the balance sheet may appear as a single list. The balance sheet is built on the fundamental accounting equation, which is assets equal liabilities plus equity. The first part of the balance sheet shows the business assets, representing anything the business owns of value or any business resource of value that has the potential to be transformed into cash. This section of the balance sheet aligns with the left side of the accounting equation. It begins with the most easily accessible or most liquid assets, such as cash and bank accounts. This is followed by current assets that can quickly be converted to cash, such as accounts receivable, which represents what customers owe the business. Other long-term assets, such as physical assets and long-term purchases like vehicles used by the business over several years, are listed next. This section also includes unrealized gains, which are the theoretical profit that a business will receive when they sell stock, a commodity, or make a currency exchange. The most recorded on the balance sheet until they are sold and the profit can be recorded elsewhere. The second section of the balance sheet displays the business liabilities, which aligns with the first portion of the right side of the accounting equation. Liabilities represent what the business owes to external parties. It starts with current liabilities, which are immediate obligations such as accounts payable, which keeps track of unpaid bills, and other short-term obligations such as credit cards or lines of credit. This is followed by long-term liabilities such as loans or larger items that will take longer than a year to repay, like equipment or vehicle loans. The last part of the balance sheet is equity, which represents the value of the business from the perspective of its owners. It reflects what the owners would have left if they sold all assets and paid off all debts. Regular monitoring of the balance sheet is crucial for maintaining the overall financial health of the business. Balance sheet, what to look at. When examining the balance sheet, there are certain things you should look at. Select the tabs. Assets. Assets provide value to a business. Assessing how well a business manages its assets involves in examining the financial value of these assets. This evaluation helps in determine whether the business is capable of sustaining and expanding its operations or it is at risk of closure. Liabilities. Liabilities represent business debts. When a business has a high amount of liabilities, it can indicate financial difficulties and may be a sign of trouble and an inability to sustain its operations. Equity. Equity is a significant source of funds that supports and sustains the business operations. When you observe a high equity balance, it can be a positive indicator that the business is capable of sustaining and growing. Conversely, a low equity balance may suggest financial challenges and the risk of the business closing down its operations. Try it out. Balance sheets. Examine balance sheet below, then use the information to answer the question.
Okay, so here's the balance sheet for Craig owns a landscaping business in California. His balance sheet as of December 31st is so current assets, bank account checking is $16,000, $719.48. Bank account petty cash is $320.95. Total bank accounts is $17,040.43. And the accounts receivable, $81.84. That's also the total. Other current assets is inventory, $519. Total current assets, $17,712.27. And then fixed assets, tools, less the depreciation is $28,971.81. So total assets is $46,684.08. Liabilities, current, only accounts payable, $100. And then credit cards, 500. Total current liabilities or other current liabilities, California sales tax payable, $1,236.05. Deferred revenue, 8,108. Federal FITA, yeah, federal income tax payable, 150. FICA tax payable, 230. FUTA payable or payroll tax is 20. State income tax is 50. Total other current liabilities, $9,794.05. Total current liabilities is $10,394.05. There's notes payable under long term, so more than 1 year, $9,515. Total liabilities, $19,909.05. Equity consists of, this is the first year or first month of the business, so 0. Owner invested $52,108.98, but made drawings of $33,172 and 50. So this is the difference. And then there's a net income of $7,830.55. Total equity as of the date is $26,775.03. The total matches the balance of the asset, $46,684.08. So knowledge check. According to the balance sheet above, how much does Craig's landscaping business have in total assets as of December 31st? So should be C. There.
The answer was commonly C. That's right.
Now, according to the balance sheet, how much is owed in total liabilities? So if you go back to top, it's $19,909.05.
B is correct.
And the total equity, 26. Which is A. What do you know about the balance sheet that this business is in relation to the accounting equation? Is the equity too high? Liabilities are too low? Equity and liability are both too high, or it balances?
Most answers D. That's correct.
Yeah, that's right. The accounting equation is assets equals liabilities plus equity. So using the figures from the balance sheet, $31,097.33 plus the equity of $7,661.04 equals $23,436.29, which is also the amount of assets. What balances? Equity lang to. Mukhang mali yung slide. Di ba 46? Well, what Martes is the correct answer is it balances. Now let's turn our attention to the income statement of or profit and loss. Loss. Joel.
Income statement provides a snapshot of a business performance. Let's review the income statement, also known as the profit and loss statement. In the video that follows, we review key points about the income statement to refresh your understanding.
Joel, wala man sound eh. Walang video.
Okay. The income statement provides a snapshot of a business financial performance during a specific time period. It includes the total revenue, which is all of the income generated from sales of goods and services provided. It accounts for the total cost of goods sold, which represents the total expenses directly associated with producing the goods or services that generated the revenue. It calculates the gross profit, which is the result of total revenue minus cost of goods sold. The income statement also includes any other business expenses incurred during the reporting period, such as rent, salaries, and advertising costs. By subtracting the total expenses, including taxes from the revenue, the income statement reveals the resulting net profit or loss for the business. The statement is crucial for evaluating the financial health and profitability of a business. Income statement, what to look at. When analyzing the income statement, there are specific elements to consider. An income statement is one of the key financial statements because it shows the business revenue and expenses during the particular period. But what are you looking for when you look at an income statement? In other words, what is the important information you're trying to extract from the income statement? First, you want to know where you want to look at revenue. When a business has a high amount of revenue, it can indicate a successful marketing process, sales process, or both. However, it doesn't necessarily mean the business is profitable. You must also look at expenses. When reviewing the expenses of a business, you can assess if the business is investing in product improvement and future growth, or if it's spending excessively on operating costs, salaries, rent, and utilities. This helps determine if the business is prioritizing essential aspects for success or wasting resources on non-essential items. Next, look at the business profit or loss. When a business generates profit, it indicates that the business revenue exceeds its expenses and costs. Profitability is key measure for success and financial health. It demonstrates that the business is effectively managing its operations, generating sales, and controlling expenses. However, other factors like cash flow, sustainability, and long-term growth and prospects also play an important role in assessing the overall health and success of a business. On the other hand, when there's a loss, it can indicate that a business is doing poorly. It's important to note, however, that a loss in one period doesn't always mean the business is in trouble. It could be a temporary setback caused by specific factors or circumstances. By closely monitoring finances and making informed decisions, businesses can take corrective actions to turn losses into profits and improve their long-term success. Analyzing revenue, expenses, and profit or loss gives a clear understanding of the business performance in a specific period, providing a broad overview of its financial health during that time. Knowledge check.
Okay, for knowledge check, first question, which area of an income statement can indicate a good marketing or sales process, but doesn't necessarily means the business is profitable? A, profit, B, expenses, C, revenue.
Revenue, mostly answered. That's right. When a business has a high amount of revenue, it can indicate a good marketing and or sales process. However, it doesn't necessarily mean the business is profitable.
Okay, let's try it out. Examine the following income statement, then use the information to answer the questions. Select the spreadsheet to download the file. What is the first question? According to Craig's landscaping business, what is the total income in December? Going back to the file. Total income is from sales of product revenue and service revenue is $13,542.64. So that is D.
D, that's correct.
And according to the income statement, what is the total cost of goods sold or COGS in December? We go back to the file. We see COGS as $510. That's B.
Yeah, that's correct.
And then next question, according to the income statement, what is the total net income in December? Net income, so less expenses, is $7,838.55. So that's letter C.
Letter C, everybody got the correct answer. Statement of cash flows.
Okay.
Balance sheet plus income statement equals statement of cash flows.
Nope, no video. Yeah.
The statement of cash flows shows where and how cash flows into and out of the business, revealing where the money comes from and how it is used. It combines information from the balance sheet and the income statement to provide a comprehensive view of cash as it moves through the business. Well, the balance sheet can show cash on hand. The business of cash flows, statement of cash flows also shows the source of the cash. So if that cash came from sales or from financing and how it flowed through the business during the period. Let's look at how this works. Consider business with $100 in starting cash, which is the amount in their bank account at the start of the accounting period. They record sales for the period and have $200 in net income, which, if that was all that happened in the business, would mean that there should be $300 in their bank account at the end of the accounting period. But that isn't always the case, is it? The situation is often far more complex. There are various factors affecting the business financial records depending on its intricacies. To accurately represent the reality, we must account for other changes in assets and liabilities. In this scenario, let's focus on accounts receivable, which tracks the money owed to you. If this account increases from 0 to 400 during the period, that means there are outstanding payments yet to be collected, as the cash for these sales are not yet hit the bank account, has not yet hit the bank account. We must subtract this increase of $400 from our bank account. This leads to an ending cash balance of negative 100, matching the amount listed in the balance sheet. This example shows why keeping track of cash flow carefully is so important. Even though the business realized a net income because the customer paid on credit, the way the cash moved through the business resulted in a cash flow problem. As you can see, while net income equals revenue minus expenses, what is not included in this equation is changes in assets, liabilities, and equity. This is why it is important to regularly prepare and review the statement of cash flows. It guides cash management decisions and promotes proactive financial planning by helping the business keep track of their cash, identify any cash issues, and plan their finance better. When you are examining the statement of cash flows, you should be looking at how cash is moving through the business. Where and when is the money coming in and going out? Select the cards. Cash inflow. Cash inflow activities that bring income into the business. For example, cash sales, receiving money for invoices from accounts receivable, or a capital infusion from the business owner. Cash outflow. Activities that send cash away from the business. For example, making vendor payments from accounts payable, making a loan payment, paying taxes, or owner draws from business profits.
Terms to know.
Operating activities, terms to know. Operating activities from the statement of cash flow includes all cash inflows and outflows related to operating a business. Investing activities, part of the statement of cash flows that includes all cash inflow and outflows related to purchasing fixed assets or investing in another business or revenue. That's investing activities. Financing activities, part of the statement of cash flows that includes owners' draws or paid-in capital. So that's financing activities. Net cash increase or decrease. That's from the statement of cash flow, total net cash difference between the beginning and ending of the period from operating, investing, and financing sections. Try it out. Examine the statement of cash flows in the following spreadsheets. Then use the information to answer the questions. Are we going faster or it's okay? Maybe there are newbies here. Just remind us. Just notify us, please.
You check the chat, Joel. I cannot see it. I might click something and close the session. Is there
There's
any
no
question?
violent reaction.
No violent.
There's
Okay.
no violent reaction.
Thank you. Okay, so for knowledge check on the cash flow. According to the statement of cash flows for Craig's in landscaping business, what is the net income for December? So we go back to the cash flow. Net income. That's the first item on the statement is $7,838.55, which is B.
Most answers B. That's correct.
And what happened with the net cash in December? Net cash. It says net cash increase, but it's a negative. So negative 39. It decreases.
Was
Let us
answer
see
C?
which is
Okay,
correct.
C is correct.
According to the statement of cash flows, what was the cash at the beginning and end of December? Select all that apply. So beginning and end. The last part. Beginning, it's $56,608.98. The cash at the end, because of the decrease, is $17,040.43. So 56 and 17. Ending is 17. Beginning is 56. That's B and D. Agree?
Yeah, all agree. B and D.
Okay. Practice scenario.
Putting it all together. Now that you understand a bit more about the key financial statements, let's look at a real-life scenario. Setting the scene. Christine, the owner of a copy and print shop, wants to know if she can afford to purchase a new multi-function copier. See, this is
Which is
question.
which statement should you look first or at first? Christine wants to purchase a new multi-function card. So balance sheet, A, B, statement of cash flow, C, income statement, statement of equity. Let's check my cheat sheet. What's your answer, guys?
There's mixed answer. It's some B, some C. But mostly it's a B.
Cash flows. It's because the topic is cash flows. So it's B.
Let's see.
See?
Di ba mag-purchase siya to checking which statement? Read
Yes, pero
again the
titingnan,
question.
diba?
Income statement yung you should check your income statement. Tama yun, Marie Chris, C ang sagot.
Kasi di ba titingnan mo kung kumikita yung business mo
Yeah,
para
correct.
mag-purchase
Exactly.
ka.
C should be the answer.
We'll see the explanation.
Oh, I think I'm on the wrong area. Kodi ko na nga mali pa.
May codex
C.
pala si
Mali yung tiningnan mong kodigo kasi.
Okay, the answer is
Huwag ka na
C.
kasing magkodigo. Tignan mo na lang yung
Hindi ka
senaryo.
namin yung
Tama naman. C, income statement if to check if the business made a profit or not. So that's my
That's correct. The income statement will show if the business made a profit or not. Para yun ang gagamitin niya pang bili ng copier. Bookkeeper response. The income statement shows that you have made a net profit of $100,000 this year. Client question. So, if the income statement says I made $100,000 this year, then why isn't there 100,000 in the bank?
which statement should you look first to answer her question? A, balance sheet. B, statement of cash flow. C, income statement. D, statement of equity. Cash flows.
Mostly the answer is cash flow. That's correct. Cash flow, great job. The statement of cash flows reports the sources and uses of cash by a business and is a great place to start with the answer to answer your client's question. Bookkeeper response. That may have been your net income, but you use the money in different ways. Some of the money was used to pay off loans, which decreased your liabilities and working capital. Additionally, you invested in new computers, which increased your assets but also decreased your working capital. Remember, to effectively help your clients, it's important to know which financial statement to use to gather the information they need. Each statement serves a specific purpose, offering insights into different aspects of the business finances. Understanding their purpose allows you to provide accurate guidance to clients' concerns and questions. Next, you see how the statements are all interconnected. The ripple effect of financial statements. Interconnectedness of financial statements. Budgeting is a helpful tool for bookkeepers. Let's hear from a bookkeeper about how it helps him support his client in gaining a clear understanding of their business finances. When when I started out as a bookkeeper, I was given valuable advice to thoroughly understand the various financial statements produced for a business owner. I now pass this advice to you. Be able to explain these statements and understand how day-to-day transactions impact each one so you can provide valuable insights to your clients and help them make informed financial decisions. A good example is to think about when a business purchases inventory and how that will show up on the profit and loss statement. Take my client, Darius. He owns an auto parts store. Recently, his massive stock of air fresheners was finally running out and he had to purchase a new batch. His current inventory came at 100 per box, but the new boxes increased to 150. Based on the costing method he's using, there's going to be a change in the cost of goods sold once he starts selling the new batch of air fresheners. This will in turn affect the profit and loss statement. And the profit and loss statement will affect the balance sheet because it will go there once the net income is recorded. It's ripple effect and it is all connected. Because of that, there are times when because that there were times when one statement doesn't affect statement corrections have to be made and it may require those connected financial statements to be reproduced as well. Are there times when one statement doesn't affect the other? Absolutely. But you want to be able to understand an accounting entry and where things are going to show up so that you can explain those to the client. They're looking to us for guidance and information. The more we know, the more confident we can be, the better it's going to be for our client. The core financial statements work together to provide a comprehensive view of a business financial performance and position. Each statement serves a specific purpose and provides valuable insights that, when analyzed collectively, help stakeholders understand the overall health and success of the business. Let's look at how the financial statements work together in the video that follows.
Video, sorry guys. Let me read this one, Joe.
Okay.
While there are four core financial documents, we're going to focus on three you'll most likely use on a regular business with your small and medium business clients. Let's look at them one by one and see how they are connected. We'll start with the balance sheet. On the balance sheet are assets, liabilities, and equity. Equity on the balance sheet includes retained earnings, and retained earnings are derived from net income. And this is our first example of how the statements are interconnected. We find net income on the income statement, often called the profit and loss or P&L statement. The income statement contains income, cost of goods sold, or COGS, gross profit, expenses, net operating income, and net income. The income statement flows into the balance sheet, where we find another moment of interconnectedness as we see a net income appear once again on the statement of cash flows. The statement of cash flows tracks money coming in, which includes income generating cash and receivables. Receivables are money owed to the business that could potentially generate cash when people pay what they owe. It also tracks money going out to purchase inventory or pay bills and changes to cash based on investment and all other cash in and cash out activities to yield the resulting cash at the end of the period. The statement of cash flows connects the income statement and balance sheet together by showing what changes have occurred from the beginning of a period to the end of the same period. On a statement of cash flows, the cash at the beginning of the period is pulled from the cash of the balance sheet at the beginning of the accounting period. The cash at the end of the period is the cash at the beginning of the period with the net cash increase or decrease added to it. This should match the balance sheet at the end of the period. It is important to understand that they are all connected. Every transaction impacts every financial statement in some way. It may be recorded as a single entry or divided into multiple entries across the statements, but it will be reflected in all of them. Watch financial connectedness happen over a specific period. Now that you understand the connectedness of the core financial statements, watch how one business transactions weave through the financial statements over the course of a month. Understanding is this video. Okay, let's you can do this one, John.
Okay. Drew has decided to get into the wedding cake business and has just opened a new wedding cake business. March is their opening month. Drew is using the basis method of accounting. We'll track the first month of transactions through the core financial statements to demonstrate the ripple effect and how interconnected the statements are with each other. Examine each of the financial statements. Remember that the statement of equity is simply the bottom part of the balance sheet. Notice at the start of the month, the accounts are all at zero, just since the business hasn't officially opened yet, but the books have been set up. March 1, let's move through the timeline and observe what happens. On March 1, Drew puts 35,000 on their own money into the business. This appears on the statement of cash flows as common stock. The total from financing is affected as well and shows a total of 25,000. And the cash at the end of the period equals 1 day in this instance, changes to 25,000 as well. The cash at the end of period carries over to the balance sheet. Under the assets category, the cash is now 25,000. This brings the total assets to 25,000 as well. On the balance sheet, under the equity heading, common stock is now 25,000. Total equity becomes 25,000 as there are currently no retained earnings. And then, since there are currently no liabilities, the total liabilities and equity is 25,000. Remember the accounting equation, assets equals liabilities plus equity. The account is in balance as we have 25,000 in assets and 25,000 in liabilities and equity. March 5, let's move on to March 5. During these first few days of business, there were some administrative and sales expenses totaling 9,000 in expenses, then total expenses. On March 5, the business made their first sale. They sold a cake of 5,000 to Pat and Lo. Drew invoiced the customers for 5,000. Let's observe how that sale affected the financial statements. On the income statement, the sale is input under sales for 5,000. Since there is currently a cost of goods sold, the gross profit is 5,000. When we add the gross profit to the negative 9,000 to the 9,000 in total expense, we end up with operating earnings of negative 4,000. And net income is also negative 4,000, which is reflected on the statement of cash flows under the net income and the balance sheet under equity, the net income. This in turn affects the total equity and the total equity and liability amounts. Moving over to the statement of cash flows, remember that the net income amount of negative 4,000 is the same as the net income from the income statement. Notice the decrease in cash of 5,000 as a result of accounts receivable. The increase in accounts receivable must be subtracted from cash because the amount was invoiced, but no cash was received yet. The total from operations changes to reflect a reduction in cash of 9,000. Cash at the end of the period is also reduced by 9,000. Moving over to the balance sheet, under assets, you can see that cash has been reduced by 9,000, originating from the statement of cash flows, and accounts receivable has increased to reflect the 5,000 outstanding invoice, making the total assets 21,000, which balances against the total liabilities and equity amount, which also is 21,000. Moving on to March 6th. On the 6th, Drew wanted to get started building the cake, but they needed supplies. So they ordered the supplies from a bakery supply company and were invoiced 1,000 for the supplies. This transaction reflects the cost of goods sold for the sale Drew made on the 5th of March. And on the income statement, increased the cost of goods sold by 1,000. This then changes gross profit to 4,000 and operating earnings and net income to negative 5,000. On the statement of cash flows, net income changes to negative 5,000 and accounts payable increases to 1,000. Because the net income went down by 1,000 and change in accounts payable went up by 1,000 because at the end of the period remains unchanged. On the balance sheet, total assets remain the same. Under liabilities, we see an increase in accounts payable of 1,000, which also increases the total liabilities. And under equity, we see net income decreased to negative 5,000 and total equity is now 20,000. But because of the increase in total liabilities, the accounting equation is still in balance as total assets in 21,000 and total liabilities and equity are 21,000 as well. March 15, moving on to March 15th. On March 15, the customer made a payment on the invoice. The customer paid 3,500 of the 5,000 that was owed. When we examine the income statement, we notice that the payment has no effect on income. Moving over to the statement of cash flows, accounts receivable decreases by 3,500 to a new balance of negative 1,500, which changes the total from operations from negative 9,000 to negative 5,500. This changes cash at the end of the period to 19,500. On the balance sheet, cash is now 19,500. Accounts receivable decreases from 5,000 to $1,500, with the customer's payment. Because the amount in cash increased from 16,000 to 19,500 and accounts receivable decreased from 5,000 to 1,500, the total assets amount remains 21,000 and the remainder of the account balances are unaffected. The accounting equation remains in balance. Finally, March 31, on the last day of the month, we can observe the final results of all the transactions and what the final accounts are at month-end reconciliation. Uh, Explore the financial statements and notice that the accounting equation balances it in the end, even with the ripple effect of the numbers moving from one financial report to the next. Tracking against the report. What is budgeting? Budgeting is all about aiding businesses in making informed decisions. While aiming for precise estimates and perfect projections would be ideal, is not always feasible. Budgeting involves creating realistic figures that enable business owners to make informed choices rather than striving to match the budget numbers exactly with the books each month. It is a systematic way to business owners for business owners to keep track of what they are spending money on and allocate out their resources properly to ensure they can pay all of their liabilities in a timely manner. Learn more about creating and examining budgets in the following video. So far, you've learned a lot about financial reports, but there's one more you are often tasked with creating and understanding, which is budgeting. A budget is often created with input from the client. It is an outline of an organization's revenue, expenses, and profit over a period of time, generally monthly, quarterly, or annually. A business budget is like a roadmap that helps allocate resources, set financial goals, and evaluate the business financial performance. It enables owners to make informed decisions for the business financial health and success. A good business budget assigns a purpose to every dollar the business earns. It should include things like average order income, revenue, average order revenue, number of product or inventory orders per month, next billable hours for service work, average payroll costs, material expenses, rent, mortgages and utilities, and last, other business expenses like marketing and advertising. Another important part of this part of working with the budget is understanding budget variance. Budget variance is the difference between the projected figures in the budget and the actual performance of the business. Bookkeepers perform budget variance for two reasons. The first reason is evaluation. Budget variance reports help business owners identify cash flow and spending issues. They also show where the business may have overspent, which is useful for making adjustments to future spending or budgets. The second reason is forecasting or prediction. A budget variance report helps create a forecast of future business spending. This allows owners to predict cash flow, identify trends, and understand how much income they need to generate to cover expenses and payroll for a specific period. Budgets and budgets and budget variances are important parts of a bookkeeper's tool belt. Understand them and use them to help your client's business stay financially profitable. Let's look at the scenario. Setting the scene. Your client Hannah comes to you with a question about whether her spending is in line with her budget. Client question. I budgeted $5,000 for equipment repair expenses this quarter. I'm afraid I overshot the amount. Can you tell me what I really spent, please?
Which financial statement do you turn for for the answer? So she talks or he asks about expenses. Expenses is on the income statement.
Correct.
Okay, so the income statement shows the business's revenues and expenses during a particular period. So it would be the statement that would quickly give you the answer to her question.
You got it. The income statement will give you the information you need. Let's take a look at that now.
So
Sir
here's the
Arnold,
income, yeah, so here's the income statement. Total income, 9,809.52. Less the total cost of goods sold, which is $405. Gross profit of $9,404.52. Less the repair expenses, 7,819.31, giving a net income of $1,585.21. Now going back to the question, the owner set aside or gave a budget of 5,000 for expenses, but this one says they incur actual expenses of 7,000. So for this question, Hannah was correct in her assumption that she overshot her budget. How much? Expenses actual is $7,819.31, less the budget of 5,000. That makes it $2,819.31, and that's letter D.
that's correct. The income statement shows that equipment expenses for the period were 7,819 and 31 cents versus the budget amount of 5,000 equals an excess of 2,819 31 cents. That's the budget variance they are talking about. What's the bookkeeper's role in creating a budget? Bookkeepers usually work with input from the business owner to create a forecast or prediction of what the budget should look like. This is often based on historical reports and projections provided by the business owner. For example, a bookkeeper might take the data from what a business spent the previous month and use that as the basis for the next month's budget. Or they could average everything the business spent the previous year and put the average as the monthly budget. How did you create a budget? There are many different ways to create a budget. First, many people use accounting software to create a budget, as this often includes templates to aid in the budgeting process. Uh, Others prefer to create a budget in a spreadsheet like Microsoft Excel and then merge it into the file with the income statement at the end of the month so they can compare income and expenses line by line. Budgeting is a valuable tool for business owners, and as a bookkeepers, we can help or provide information they need to create a budget. We can run reports with historical data to give them a starting point. I do the books for Jim, who, funny enough, owns a gym. He brought me and he brought me on to make sure his records were up to date and to help him with budgeting. Now he's the ultimate decider of where and when to spend money, but the reports I gave him on his financial standing over the last couple years helped him see trends and gave him an overall idea of what type of money he'll expect to see coming in and when. You don't always think about it, but gyms can definitely see seasonal upswings. January is huge with everyone trying to make good on their New Year's resolutions. Helping business owners read reports and see business trends like peak seasons can show them where they should allocate funds for those busy times and even for slower times throughout the year. Jim was actually doing just fine before, but the information I gave to him solidified his understanding of his business and he felt confident in making a budget for the year. Now Jim's not running away from budgeting. He's running towards his business goals. Summary activity. Scenario. Setting the scene. Your client Frank, the owner of a cafe, calls with some information about an incorrect entry in the books. Client question. I was looking over the reports you sent me and I noticed that you have $5,000 in sales listed, but I made 15,000 in sales last month. Bookkeeper response. My apologies. Let me go in and fix that and I'll update you when I'm done. So as to what that means for the rest of your books. Sir Arnold?
Okay, so here's the income statement from last month for Frank's business. We'll use it to answer the question that follows. Sales is 5,000. Remember, the owner says it should be 15,000. Recorded total cost of goods sold is 1,000. That brings a gross profit of 4,000. And total expenses is 9,000. That gives, although it says net income, they do incur a net loss of $5,000. Or we can say net income is negative $5,000. That will be the same. What would the new net income be once you make the change? So what will be the change? Instead of 5, it should be 15. If this is 15, we take out 1,000, that's 14. We less expenses, 9. So instead of negative, we should have a $5,000 profit. All agree?
Yeah, they all agree. All answers. 5,000.
Yeah, that's letter C. With the updated sales revenue of 15, the new gross income would be 14. And then the ripple effect through the rest of the income statement, ultimately leaving net income of $5,000. So,
Now that you have the new net income from the income statement, you'll need to carry the amount over to from statement of cash flows to determine the effect that has.
statement of cash flows. Examine Frank's statement of cash flows and use it to answer the following question. Net income has been updated to the new amount based on the previous question. So new net income is 5,000. There's a decrease in AR of 2,500, increase in AP or accounts payable. AR for the non-accounts and AR is abbreviation for accounts receivable, AP for accounts payable. And total from operations, we're talking about cash flow, so that this one means total from cash operations is the $3,500 or $3,500. There's no cash from financing, so that's zero or blank. Common stock is $25,000. So that's the same amount for cash from financing. Cash at the beginning of the period is zero. So what will be the cash at the end of the period? So we add total from operation 35. There's none. There from financing is 25. So that's $28,500, which is letter B. All agree? Or anybody has a different answer?
Yeah, yeah, most of them are B. Yeah, all are
So
B.
basically, for that question, if there is Remember, it's cash from operations, cash from financing. What's the other one? I think there's three items. You only add them to arrive at the cash at the end of the period. So there's only two, 28,500. Whether we should
Investing
be
yung isa.
investing in.
Great
Yeah.
job with the new income of 5,000. That would change the total from operations to 3,500. Ordinarily, this would affect the cash at the end of the period and change it to 28,500. With the updated net income and cash at the end of period amounts, let's turn our attention to the balance sheet to see what has been affected there.
Okay, under balance sheet, use the assets portion of the balance sheet and the information from the prior section to answer the question that follows. Balance sheet cash is 28,500, right? Plus AR, so that's 31,000. Question is, what effect does the new cash at the end of the period have on the balance sheet? Under assets, the cash is 18,500, which this is the incorrect amount. 28,500 total assets. That's one. This is probably the best answer here. No, cash is not 5,000. So one tip for this type of question, sometimes you can easily get the correct answer. We know that cash is 28,500. So just looking at the first part of the option, says under asset, cash is 18,500. So that makes it already incorrect. This letter C says cash is 5,000. Again, it made the option incorrect, as well as on letter D, it's 50,000. Because we already checked that cash is 28,500. So logic dictates B is the correct answer.
That's the good technique. Okay, correct. With the new cash at the end of the period, the cash would be 22,500 and the total assets would be 31,000. Finally, let's look at the statement of equity. Examine the statement of equity and answer the questions that follow. Note, larger companies, especially those that publicly trade stock, typically have a more complex statement of equity than is represented here. Assume the retained earnings from the last period was zero.
Okay. Equity, common stock 25,000. Retained earnings. They said to assume retained earning from last period was zero. We go to the income statement, right? No, total assets is 31,000, remember? And the equation is assets equals liability plus equity. But we don't have the liability. What was the net income?
The net income is 5,000.
Okay, yeah. Because of the 15,000 sales. Okay,
Yes.
remember. Okay, so remember this is going to be the end of the period. So although it says assume return earnings zero, because of the operations, we got $5,000 net income will become retained earnings. So that makes the total equity to 30,000. That's 25 plus 5. Recommends to be from the cash at the end of period. The question is, where do we find the amount to be entered from the income? It says from the income statement, but it's the negative amount, so that makes it incorrect. So it should be letter C. It says income statement, retained earnings, prior period, and the amount is correct. This option, it says cash flows. So we don't find the income on the cash flows.
They all answer C. That's correct.
Your retained earnings amount is pulled from the net income line on the income statement plus the prior return earnings of zero. So the new amount would still be $5,000. This would make the total equity 30,000. The final statement of equity looks like this. 25 common stock, retained earnings 5,000 from the net income. Total equity is 30,000. Okay, go ahead.
Remember, always refer to the accounting equation assets equals liabilities plus equity to make sure the accounts balance. Let's look at Frank's revised balance sheet to be sure everything is in balance before we talk to the client.
Okay, under assets, there's cash of 28,500 and then accounts receivable of 2,500. Total assets will be 31,000. Under liabilities, AP or accounts payable is still 1,000. And the new equity composed of common stock 25 and retained earnings of 5, total 30,000. Liabilities 1,000, total equity 30,000. The total of liabilities and equity is 31,000. So the balance sheet is balanced. Looking at the balance sheet, you can see it all as just repeated what I said. So after this, it's time to call Frank and let him know what you found out. Joel?
Hi, Frank. I made a change to your sales revenue, and I want to let you know the effect it had on your books.
Question: what can you tell Frank about his business based upon examining his financial statements? Statement 1. I've looked at your financial statements. Your new cash at the end of the period is 31,000. Your total assets are 28,500 and your total net income is now 5,000. So this part makes it incorrect. This should be the total assets. This part is incorrect also because this should have been the cash. This is the only true statement or true statement on that option. But the first two parts are incorrect, so it's not. I've taken a look at your FS. Your new cash at the end of period is 28.5. That's correct. Your total asset is 31. That's correct. And your total net income is now 5,000. So that's the answer, I guess. Option, from what I can see from your FS, your new cash at the end of period is 28.5, which is correct. Total assets 31. Okay, so what is wrong here is the net income. It should have been 5,000. So correct answer will be letter B.
Most answers B. Th- um, Thanks. That's great information to have. Thank you for making the change so promptly.
Okay. Yan, may mali ako. Mali. Ako. Balik. Paano yan? Mali. Try again, right? Question 1. What information on the balance sheet should a bookkeeper focus on? Revenue, expenses, and profits, cost of goods sold, total income and equity, assets, liabilities, and equity, assets, revenue, expenses. Remember, we're talking about the balance sheet, so it should be assets, liabilities, and equity. Cost of goods sold, total income, that's income statement. So this should be C.
All answers correct. C.
Question 2. Which document shows how cash is moving throughout the business? So cash moving in and out, that's cash flow.
Correct. All answers A. Cash flows.
Question 3. Which document is useful for evaluating if a business made money over a specific span of time? If the business made profit or made income. So that's letter C. Income, profit and loss statement. Question 4. Which of these are reasons for budget variance reporting? Select all that apply. Comparing the budget prediction against the actual spending of the income statement at the end of a specific period. Yes. Reporting discrepancies between cash brought in and cash spent during the course of a period. I don't think so. Budget variance. Discrepancy, no. Tracking financial performance over a span of several time. You're not comparing, you're tracking. Forecast or prediction of what the business spending should be for the future. So budgeting, there's one period, the budgeted or what they like in Congress, they budgeted something. And then there's actual use of the funds.
Yeah, most answers A and B.
Yeah, the evaluation of past spending and prediction of future spending. Question 5. What are the 4 core financial statements with which every bookkeeper should be familiar with? Select all apply. We should be familiar with this by now. The balance sheet, the income statement, cash flow, and the equity. Agree? So that's B, C, E, F.
That's right. Everybody agree.
Pero 80 lang yan. May mali ako isa. Oh, again 100? Nag-try again nga pala. Okay. Congratulations, you're one step closer to being a bookkeeper. And submit. We will go to... Oh, ang bilis natin, Joel ah. Baka mapagalitan tayo.
Okay lang po yan. Hinahabol po din kasi na matapos siya this week eh.
Ayaw nga pala kasi mayroong tax
So we're
preparation.
done
Yes.
with examining. This is the next part, analyzing business performance. Are there any questions on the chat for the non-accountants? Are you still okay? Okay, Joel, let's start with no. Wait.
For the non-accountants or newcomers here, anyway, you can so listen to the replay and listen with your own pace.
Yeah, and if you have questions, you can chat on your respective chat rooms or GCs, and then somebody will surely answer a question. Okay, for this one, Joel, please.
Bookkeepers are often asked to help assess the overall health of a business compared to other business in its sector or industry. But how do we do that? We use the ratios to understand a business liquidity, efficiency, solvency, and profitability. Then we can use those metrics to compare the performance of the business across its history, the business to other business in its sector or industry, the actual performance of the business with its goals, and the business to industry standards. We can also assess the trends over time by using the income statement. Being able to analyze financial documents and use them to effectively assess the performance of a business helps you better serve your clients.
Okay,
The
this is just a
glossary,
review of the glossary. Uh, Next part.
analyzing the balance sheet, digging deep to gather information. Financial ratios are commonly used to analyze financial statements. Let us explore why in the video.
In the video, there is no sound. So we're gonna read again.
In in addition to looking at the values of the balance sheet, we can use several financial ratios to analyze financial statements. Financial ratios showcase a relationship between two or more numbers that are taken from the financial statements. So, what are the benefits of using financial ratios to analyze a business? Ratios let you compare the averages of the industry in which the business operates, ratios of other business in the industry, previous years, ratios, and planned ratio thresholds for current and future years. Ratios can also be used to analyze various metrics, including liquidity, which is the ability to pay down current liabilities, typically expressed as a ratio or percentage. Efficiency, which is how effectively a business is doing something over a given period of time. It can be measured for a number of different aspects of the business. Solvency, which is a business ability to pay long-term debt, and of insolvency, which measures when a business is at risk of being unable to pay its debts or as they come due. Understanding these ratios and how to use them to compare the business to other metrics will provide a more in-depth view of the business. Its financial statement provides unique insights into various metrics. Let's look at the balance sheet matrix for liquidity, efficiency, and solvency. Liquidity. The balance sheet matrix for liquidity are current ratio, cash ratio. For efficiency, the balance sheet matrix is accounts payable turnover ratio and accounts receivable turnover ratio. Solvency. For solvency, the balance sheet matrix are debt to equity and debt to asset. Balance sheet matrix, which is liquidity. Let's start by looking at a liquidity matrix from the balance sheet. Current ratio. Current ratio equals current assets over current liabilities. Liquidity current ratio. The current ratio is a simple way to understand if a business has enough current assets to cover its immediate debts. It helps assess the business ability to pay off its debts once they come due.
Okay, for the non-accountants, it only means that the current assets can be easily convertible to cash, which makes it usable to pay debts or payables. Joel?
Uh-huh. What does the current ratio mean? A current ratio greater than 1 signifies a healthy financial position while a current ratio less than 1 could indicate trouble meeting short-term obligations.
What does it mean? Because you may have question why it's greater than one. Let's say you have a payable of $1 and you only have $1 also. So if you
So
go
that's
by the
one.
ratio, that's equal to one. So you only have enough money to pay your debt or payable. But if it's greater than one, that means you have enough assets or enough current assets to convert to cash to pay your debts. And will still leave you with something after paying the debts. So less than one is not a very good ratio, a current ratio, because you don't have enough current assets to turn into cash to pay your debts.
The-
That means it is not liquid.
There is a question in the chat. Is
Okay?
fixed assets fixed assets included in the current assets?
No.
Question by JR.
Current assets, usually the measure is it is easily convertible, or if you are able to turn the assets to cash like within max is 1 year, or it should be 1 year or less. If you cannot convert that 1 year or less, it should be not part of the current assets. Fixed assets, that should be PP. The most of the items that are depreciated, those are fixed assets. Those are hard to sell sometimes. So
Yeah, so the
basically, yep. Sorry,
yeah
go
the answer is no. Okay.
Okay.
Yeah.
Let's talk about current ratio. The current ratio is a liquidity ratio that measures a business ability to meet its short-term obligations with its current assets. Banks use the current ratio to determine a business eligibility for loan, is specifically for things like a vehicle loan. It's calculated by dividing current assets by current liabilities. Current, current assets include cash, accounts receivable, inventory, and any other assets that are expected to be converted into cash within 1 year. So that's what I'm trying to tell you earlier. Or the operating cycle of the normal operating cycle of the business, whichever is longer. Current liabilities consist of obligations, so payables, that are due within 1 year of the operating cycle, including accounts payable, short-term loans, and accrued expenses. To improve the current ratio, a business can increase its current assets, reduce current liabilities, or a combination of both. This might involve strategies such as increasing sales, optimizing inventory levels, negotiating better payment terms with suppliers, or refinancing short-term debt. Uh, Joel?
Ah, let's look at a scenario. Setting the scene. Javier, Javier owns an auto body shop and has $500,000 in current assets and $250,000 in current liabilities, making the current ratio of the business 2. Javier calls Sarah, his bookkeeper, with some questions. Client question. I know you told me my current ratio is 2, but what does that mean? Bookkeeper responds, great question, Javier. A current ratio greater than 1 indicates that your business has more current assets than current liabilities, suggesting a strong ability to meet your short-term obligations. Note, a high current ratio typically signifies a healthy financial position, giving stakeholders confidence that the business can pay its bills, invest in growth, and handle unexpected expenses. Thanks. So I'm thinking of getting a new hydraulic lift for the shop. It would cost about $325,000. I plan to finance the entire purchase and pay it off in 10 monthly installments. What would that do to my liquidity?
What would the new current ratio be if Javier purchased the hydraulic lift? So remember, going back, we have our current ratio of 2, 500, so 250. 500 minus 325. This will be payable in 10 monthly. So this will decrease. What would the new current ratio be if Javier purchased their road cliff? First option is 0.87, and then 1.15, 1.5. A, B, or C?
Was answer
What's
is A.
sure? No violent reaction?
Yeah, it's A. Correct.
Okay, so current ratio. So adding the 325 to the liabilities, the new current liabilities total is 575. What happened to the current asset is 500,000 because the hydraulic is fixed. I think one of the questions earlier is fixed asset part of the current assets.
And we add the
So
value of the hydraulic to the asset.
no, to the total assets, but not to the total current asset. Remember, the total current asset at the
Ah,
beginning is
okay.
already 500. So you might ask, we purchase an asset also, the hydraulic, but that type of asset is long-term use, subject to depreciation. So it's an asset, but it's a fixed asset.
Ah,
So
okay.
in the computation of current ratio, we don't include that. So somebody must be asking why we don't include the 325 hydraulic on the computation because it's not current asset.
All right.
So the total liability is 575. Okay, so to answer the owner's question, that would bring buying the hydraulic, that would bring your current ratio to 0.87. Current ratio below 1 generally suggests that your business may struggle to meet its short-term obligations. I suggest talking to your accountant before purchasing the lift. Note, a low current ratio could indicate liquidity issues, such as potential inability to pay bills on time or to take advantage of business opportunities. It is crucial for business owners to address this imbalance and improve the current ratio. Knowledge check. What is the correct formula for calculating current ratio? This option says net credit purchase. It's already wrong on this part. Current assets by current liabilities. This says net credit sales. So this already makes it incorrect. And then it says here accounts receivable. So that's also incorrect. Uh, Total liabilities. No, we only use current liabilities. And then this part is also wrong. So it should be B. Current assets divided by current liabilities. That should give you your current ratio. Try it out. Calculate the current ratio. A clown school is trying to find out more about their liquidity. Sanjay, the owner, has provided you the following balance sheet. Use it to calculate the current ratio for school. Total assets. Current assets, $73,119.65. Current liabilities, $12,201.24. Current equity, $7,120.02. And then the total liabilities and equity. So from these, we only take current liabilities and current assets. So 73,000 divided by 12,000. So that should be around 1248, 1250. Should be high. A 3.78, B 10 down 10.27, 5.99 C, and then D 26. Is it C?
Yes po.
Because
Most
10
answer C.
because 10 will be 120. It's only 73. So 5.99. And the other options are lower. Okay, the current ratio calculated by dividing current assets, that's 73,119.65 by the current liabilities, 12,201.24. The resulting ratio is 5.99 rounded to the nearest hundred. Joel, cash ratio.
Cash ratio equals liquid assets over current liabilities. Liquidity cash ratio. The um, cash ratio shows how well a business can meet immediate demands from its most liquid assets. It helps assess the ability to pay off in immediate creditor obligations. What does the cash ratio mean? A cash ratio greater than 1 indicates that the business has sufficient liquid assets to meet its current obligations, while a ratio less than 1 means that a business might have trouble meeting obligations. Let's look at this scenario. Sarah owns a sandwich shop that has a cash balance of $10,000 and accounts receivable balance of $13,000 and current liabilities are $6,000. What is her cash ratio? To calculate the cash ratio, use the formula cash ratio equals liquid assets over current liabilities. Cash ratio equals 10,000 plus 13 over 6,000. Therefore, the cash ratio is 3.83. This means that Sarah has $3.83 in liquid assets, cash and accounts receivable to cover every $1 of current liabilities.
One might ask, is the current ratio the same as cash ratio? Sometimes, given if the given is only like this, then yes, it will be the same because those are the current assets, but not in all cases. There are cash and cash equivalents. There are current assets that would need more time to convert to cash. Knowledge check. Sarah buys a new walk-in cooler for the sandwich shop for 8,000 with cash. Calculate her new cash ratio. So from 23,000 minus 8,000, that's 15 over 6. So that's 2 point something. Should be 2.50.
Yeah, that's correct. All got the correct answer.
So again, cash is 2,000 because of the purchase plus the 13,000 receivable. New ratio is 2.5. Joel?
Accounts payable, AP, turnover ratio, accounts payable, turnover ratio, liquidity, accounts payable, turnover. The accounts payable turnover ratio represents how many times a business pays off its accounts payable during a period. This shows how efficient a business is at paying its suppliers and current debts. Note the average accounts payable amount is found by adding the beginning and ending accounts payable for the period and then dividing by 2. So the formula accounts payable turnover ratio equals net credit purchases over average accounts payable. What does the accounts payable turnover ratio mean? When comparing the accounts payable turnover ratio of two businesses, the higher ratio indicates which business satisfies its accounts payable obligations more quickly. Always compare the accounts payable turnover ratio to similar businesses in the same industry because industries have different payment practices and financial structures. Comparing to industry benchmarks provides context and helps identify if a business payment practices align with industry norms. Try it out. Calculate the accounts payable turnover ratio. Bob's Bakery Supply business purchased $600,000 worth of baking equipment from his vendors during the year. Use the following balance sheet to calculate the accounts payable turnover ratio.
Okay, so this one is simple for computation, beginning and ending. So that's 35,000 plus 458,000 gives you $493,000. They only give us 600,000 for purchase. You might ask, but the formula is net credit purchase. There's no information, so we assume that this is the net purchase. But for uh, all intents and purposes, sometimes when you purchase something, you can have returns, allowances, or discounts. So those items affects purchases before you arrive at the net purchases. So what's the so 600,000 is the purchase or net purchase from the formula over 493. Should be either A or C because this one's too high. $1.22 rounded off A.
Yeah, that's correct.
Eh,
Oh,
243? What?
Kailangan
Oh,
i-divide yung yung beginning plus
I
end, di
two.
ba?
Hindi
I-divide
pala
siya by
na-divide.
2.
Hindi pa na-divide, sorry.
Oo.
Na-misstep. So again, 35,000
Plus 458. Divide by
plus
2.
458 divide by 2. Kinulang lang. 296.5. Tsaka mo siya i-divide. Okay. Hmm? Tama ba? Ba't mali? Mali ako. Mali itong ano ko. Nakuha ko. 293.5 ba? Di na marunong mag-calculator.
Hindi, 458,000.
Tsaka 35 divided by 2.
Yeah.
246. Mali. 600 to 46.5. Yun, 243. Again, 243. So that's letter D.
Okay, got it.
Yun. Okay, so na-miss lang yung pag-divide ng 2. According to Bao's balance sheet, his beginning accounts payable was 35,000. His ending accounts payable was 458. So the average is 246,500. You get this by adding the beginning plus the ending and dividing by 2. Based on this formula, turnover ratio, AP turnover ratio is 243. That is to see how often, on average, Bob basis vendors we divide 365 days that's days in the year, by the ratio, and we get 150.20. This means that Bob basis vendors on average once every 5 months. Why 5 months? 150, if you divide by 30 days in a month, is 150 over 30 is 5. Because this is days by ratio. So they're saying on the average, Bob is paying once every 5 months. Oh, there's a computation. 150 over 30. If you ask where the 30 comes from, it's from the the usual number of days. For non-accountants, you might ask, there are months that has 31 and February has 28. In general, it's 30. Most of the time it's 30 for like formulas like this. It doesn't have to be exact.
Okay.
Joe.
Accounts receivable turnover ratio. The
I
accounts
think wala
receivable.
na pong time. 8:58. Kasi mag-i-start na yung
mahaba pa ba?
internship ng 9. Mahaba pa po yan.
Ay,
Tuloy na
okay.
lang bukas po.
Okay.
Okay. To be continued tomorrow.
Thank you, everyone.
Thank you.
Thank you.
I
Bye.
think Chris raising his hand. Chris has something to say. Go ahead, Chris.
All right, thank you guys. So yeah,
Should I stop sharing first?
oh yeah, you can. Thank you. It was it Arnold?
Yeah.
Yeah, I didn't know Arnold. You have a really good, I don't know. I didn't know you speak that way, basically. Very, very good. I like what I hear.
Thank you.
Good job. My pleasure. So today would be the start of the internship. So after this, for those who are part of the top 10, I'll send you guys a link on the messenger that Kelly created, or the GC that Kelly created. And again, for those who would want to join the stream, you can join just as an audience, so you can chat or you can post questions that we can also answer along the way. So you already know where to go if you want to join, okay? And for those who are part of the internship program, again, just check out the link on the GC that we have. Other than that, I guess it's been a good run today. Thank you guys for joining us, and I'll see you guys again tomorrow. And I think may review ba kayo, Ma'am Sean, or Cherry, ng EA?
Hi, Chris. We're not having the review today. Manonood kami ng internship.
Okay, all right. All right, guys. So I guess that's it for tonight. I'll see you guys tomorrow, and for most of you, or for some of you, I'll see you in the stream. All right. And then, sino bang host today? I'll let you take over.
Kelly is the host.
Kelly is the host. Okay. All right. I guess that's it. I'll close for the night. Thank you, guys. Again, I'll see you tomorrow.
See you.
Okay.
Good night.
I'll be early tomorrow. Ngayon lang ako na late kasi wala ako tulog earlier. Deadline kasi. But tomorrow I will be able to join you at 7. All right. See you guys. Bye-bye. Have a good night.
Good night.